we start, I'd like to provide just a little bit of background and context. I'm sure the attendees here, you're all very aware of the healthy markets, especially on the M&A side. As a virtual data room provider, we're probably seeing about 8,000 deals this year on an annual basis in a run rate. That's a double-digit expansion in terms of volume that we're seeing in 2017. So in light of that, we'd like to kind of discuss three kind of factors related to M&A and get the panel's insights. The first is going to be policy-driven factors related to M&A. The second is going to be valuation and financial drivers. And the third, just as important, if not the most important, is operational integration issues related to tucking in acquisitions. So, the first question here, and I'd like to start off with Jack and Bob and then open it up to the panel. In terms of protectionism, it seems like what's cement at this point with a lot of what the administration's been saying with the Chinese tariffs, et cetera. And we've also heard there's been a vocal minority of U.S. companies manufacturing in China saying that they're looking to move operations overseas. Is that really where we're at the moment? And what are you recommending to your clients to get ahead of these issues?
Well, for my money, and it is my money since I'm a lawyer, nationalism, it's not about our current president. It's been something that's been happening for quite some time. 10 years ago, there were only a handful of pre-merger filing regimes in the world. Now there are about 120 out of just slightly fewer than 200 countries in the whole world. And they're saying they're weaponized is overstating it, but the relevance of them in a global economy is hard to overstate. I got an email from somebody in a country in Africa last night explaining that the local authority wanted our two major shareholders to show up and explain why their involvement in this merger wasn't an anti-competitive issue. The two major shareholders were Vanguard and BlackRock. I got this letter, and I thought first that one of my partners was kidding around with me, but it's not. That's just a function of these regulators understanding better how the global economy works, in particular the financial markets. But it's not just the national champion issue. Sort of, if you think back a few years to Alstom and GE, what it went through to complete that deal. It's really much more rampant, where countries are doing things that are designed to deal with their immediate self-interest and not necessarily really implementing their policies. Now, what do you do about that? Well, obviously, it's case by case. With 120 countries, I mean, the thinking that goes underneath this today is really quite staggering. But the hardest thing, especially for somebody like me who's been doing this forever and sort of think I understand what I'm doing, is to forget all that and to really localize your thinking. It's very hard it's going to be very hard for me in a sort of condescending way to communicate with this regulator in Africa about BlackRock and Vanguard. That won't work. So you really have to localize what you're doing, and that requires a team approach that is much more, well, it's broader, and you need much more than you used to, because the smallest things can obviously have a very significant impact. And then the last thing, and maybe I'll transition to a financial analysis of this, is it's getting to be that I think you've got to model this stuff. Because very often it's the divestiture of a minority interest in a locally public company and being done in a way that frankly isn't designed to maximize the value of that. And how do you figure all that out? It's not just a bunch of papers that need to get filed and things that lawyers can do, because very often, especially I think many of these regulators have figured this out, they can get away with a lot of stuff for them if it's small in the context of the overall deal. I'm sure people in this room could give story after story about how basically a local regulator took advantage of the situation and caused something to be done that didn't really jiggle the fundamental economics, but sure affected the ultimate return analysis.
Bob, I'd say, my 2 cents on this, I would say to you that protectionism is another manifestation of event risk. And when I think about it from a deal perspective, I think about event risk and how it overcomes things. And so in the current wave of protectionism, whether you're looking at just U.S.-centric or looking at it cross-border, there are winners and losers, not just on a macro scale, but on an industry-by-industry scale, on a company-by-company scale. So when tariffs get imposed and Ford announces that it's going to lose $1 billion that it hadn't anticipated losing, that's a loser in that thing. On the other hand, when you look at a country like India, where a lot of people are beginning to source things out of China to India at the moment, India becomes a winner in those things to the expense of China. We're in the process of, we've signed a letter of intent to acquire a technology company, and we're resourcing things right now out of certain countries in Asia because of this and because of some of the tariff issues that are going on to other countries that the U.S. has decided don't require the tariff penalties. And so people do react to these things, but I think about it just from an event risk perspective, because event risk is what affects value more often than not. It's the single, in my view, the single leading thing that becomes value destructive.
I think one of the mitigations to event risk is to think about diversifying the global supply chain. So I think that's a key strategy that a lot of organizations are thinking about in terms of how best to mitigate this. So there may be an issue with China, but there's a whole global supply chain there that needs to be thought through, and understanding it and then optimizing it, I think, is a big issue. And there's a lot of organizations that have not yet optimized how they want to think about their global supply chains.
Do the panelists think the administration's really going to be digging in the next 2 years, especially if Congress does get split today on these issues?
One of my former partners is our international trade negotiator. I think he and the team working around him have a very clear perspective that has been adopted by the president and by the current administration. I don't see that changing in the short term. I don't know about you, Bob. I completely agree, and I was thinking about your event risk point. One of the other things, I've got a transaction where a Canadian seller is selling an interest in a South American company to a Chinese buyer. So who's playing a key role in this? The United States. It's CFIUS. What does it have to do with it? Nothing, really, except that it's there. So it's part of this point you were making that, and I was trying to make, and maybe an overly lawyerly way, is that you really got to look at all this stuff, and really on a granular basis. It used to be that these things were kind of thought as second and tertiary aspects of it. It just needs to be taken into account, and you've got to be willing to make some sacrifices, I think, to get closings done very often. Much more often than you would think, let me put it that way.
Great, thank you. Now we're going to move on to finance and valuations. This, again, a little bit of an Intralinks plug. We've been acquired 3 times in the past 2 years, all at a premium, but it's been we've been overly drinking out of the fire hose of a healthy M&A market here. In terms of valuations, I want to start with Jeremy, Greg, and Chris here. What are your general thoughts on valuations right now? I mean, we've seen an epic bull run up till 2 weeks ago, I guess, about a week ago. And the immediate inclination is to think that there'd be some disconnect, at least on the public company acquisition side. Where's valuations at right now on the public company side and on the private company side, from your viewpoints?
Yeah, I can kick things off here. I think it's no secret to the folks in this room that valuations today across most sectors are at or near record levels. We see that in the stock market. I think, as we're talking to business owners today that are looking to potentially have a liquidity event in the next several years, it feels like now is the time to consider something like that. I feel like it feels like depending on the sector, we've seen about 8 years of year after year multiple expansion really across industries. Mm-hmm. And it feels like we've had a little bit of recent volatility. I think we're all trying to figure out when's the next recession coming and what are the catalysts for a downturn. I think as we sit here today, we've got line of sight on interest rates, right? They're going up, they have been. There's been some reaction to that in the equity markets, a little bit of a pullback there. So my view in terms of overall valuations is that I don't know that we're necessarily falling off a cliff, but I feel like I don't know that there's a big uptick from where we're at today. Again, I think a lot of that is driven just by There's a lot of capital chasing deals right now. Again, we're all familiar with that. A lot of private capital, a lot of cash on the balance sheet. So I feel like from an overall M&A market perspective, there's going to be a strong bid in there for years to come. That's kind of my general view is that, again, if you're a business owner, I think let's wait a year, let's wait 2 years has been a good strategy historically. I feel like that may be coming to an end to some degree. Again, I don't think things are going to crater from here, but it does feel like we've got a couple catalysts in place right now that will limit that upside a bit from here.
Yeah, I mean, just to pick up on some of those themes, I mean, our firm, again, focuses exclusively on tech, media, and communications. A lot of what we focus on are privately held or private equity or venture-owned businesses, which probably most folks in the audience are more on the private company side than the big Fortune 500 side. And so within the privately owned businesses, certainly the last 5+ years has been a phenomenal run. It's been a great time to be on the sell side as a founder and owner of a business. In the sectors that we're involved in, a couple of things have been driving that. One is certainly growth and the ability for an acquirer to acquire that growth. And the second, which does lead to some toppiness, is FOMO, fear of missing out. And there's a number of transactions where big strategics as well as very thoughtful private equity firms have paid substantial premiums, not only in transactions our firm's been involved in, but others in the market because of that. And one of the things that we're seeing anecdotally in some of the transaction activity our firm's involved in is a little bit of that is slowing down. And I think what's happened is anytime one's in a 5+ year M&A run, you start getting either the corporates or the private equity buyers who bought a company 3 or 4 years ago and the growth trajectory didn't work out as planned, or they thought they were buying a cutting-edge technology in the FOMO category, and they found out that there were a couple other competitors in other parts of the world, and what they were buying wasn't so special. And so what we're seeing now, here in 2018, heading into 2019, is still very strong, especially on traditional auction sell-side M&A processes, but buyers are becoming a little bit more discerning. And if you're missing a quarter of growth, instead of lowering the bid, they're actually pulling out of an auction. If they're doing some diligence on the technology and they're not fully satisfied, they may hold back or lower the offer. So those are elements of a market where certainly quality companies, well-placed and growing, will receive full and fair value. It's more the companies below that elite echelon that are, I think, going to be having some challenges in valuation and transaction, ability to transact going into 2019.
If I could just square Jeremy's comments a bit. So I do diligence, so I'm very involved. I'm not much of a soothsayer, but focused on individual deals. But in my experience and having done a lot of research over the years, one of the things we know is that merger waves are correlated with rising stock markets. Like, that's sort of obvious. But when you start getting the kind of volatility and worries about overall stock market valuations, that tends to put the brakes onto merger activity for the main reason, if you think of the way deals are structured. Over the last several years, there's been about a third cash, a third hybrid, and a third all stock. So what does market volatility do to those prospective stock deals? Well, they get really uncertain. And this is where you get the tension during a merger wave where the sellers are used to having a higher share price. So they're anchored on their higher share price. The buyers, and they don't necessarily want to take stock from a buyer whose share price might be fluctuating. So about 2/3 of deals get into a lot of this tension between buyers and sellers and the use of stock and how much it's really valued. So that's just something I want to say with kind of square Jeremy's comments.
I just wanted to add. I mean, I think the consensus is that the market is close to the top. I do think buyers are becoming more disciplined, and on the sell side, I mean, this is a great time to sell, actually. And what's surprising is that there's not more divestitures, not more sell side activity. And I think if you look at valuations, I mean, particularly with this migration towards tech M&A, which we've seen over the last few years. There's a lot of pre-revenue companies, a lot of pre-EBITDA companies that are looking for pretty crazy valuations, actually. And I think we've started to see those temper a little, but it's still a pretty buoyant market. And if people are on the sell side, I think now is a great time because the cycle will turn. It's a cyclical industry, and I think we are close to the top. I think one of the trends I've seen, just to perhaps dig a little deeper here, is this trend towards customer-based valuation. I've spent a few years here in retail and e-commerce and media, and there's increasing focus around taking customer behavior into account when thinking about valuation. And I think that's a really interesting trend, which is getting to the fundamentals in a way that perhaps we haven't seen before. And I think that's going to continue and going to drive fair evaluations for both buy side and sell side. But we're definitely close to the top, in my view.
So 2 quick observations, 2 quick anecdotes about the market we're in right now. Observation number one, there's more cash around right now than almost any time in our history. And oh, by the way, that cut in the corporate tax rate has not, at least up to this point in time, done anything other than put lots of cash on lots of balance sheets that are going to need to be employed. So lots of cash both in corporates, lots of cash out in funds and in private equity looking to be deployed. Observation sort of, and I think that drives, I think I agree with you on the uncertainty in terms of what's stock, but there's lots of liquidity driving things. And what's that mean? Well, 2 anecdotes. One of my friends who's a senior banker at one of the houses here in town talked to me last week about one of his fund clients who called him up and said, hey, I saw this change in the market. I just put $120 million into this name. Tell me about it. Tell me about the name. Tell me about this company. Literally, made the investment off the desk, now calling to find out what have I just invested in, right? And you laugh at that, but that is not uncommon on trading desks right now.
We should all be so lucky
right?
to do that. Trade like
one. Number 2, I was with a senior guy at a family office in the Midwest, one of the major family offices in the Midwest a couple weeks ago, and they were talking about the fact that in their diversification, they're invested in 3 or 4 of the major private equity names. It doesn't matter who they are around the country. And they were lamenting the fact that what they were actually doing in that portion of their portfolio is they said the only loser at the table here is me, the family office investor, because that's investing in these things because those 3 firms are getting in all these trades and are moving the multiples up against each other, bidding them up against each other and selling them back and forth to each other, and it's my money. I'm the investor sitting there at the LP level, and the market is getting to a point. And I'll just make the observation, at our fund, what we tend to do is look, as not surprised to any people here know me, at stressed situations, at situations where you can buy assets at some kind of a reasonable value. One thing I know for sure, I add no value in a regular way M&A trade where someone's paying a 14 multiple. I don't know how you make that asset better in order to be at the kind of return you want to get a return for your investors. I don't know how to do it. There may be other wizards out there who do know how to do it. Because my view in a transaction is very few things you can control, event risk being one of the things you can't control. The one thing you can control is what you buy the asset at. That is the one thing you can control.
That's right.
And if you do that on a disciplined basis, at least you give yourself a shot to manage some of the other issues.
So let me just follow up that. This is great. When they had to replace the mic here a few minutes ago, reminded me of an old saying about theater that by and large the technical goes unnoticed in theater until something goes wrong. If a door handle falls off and you're watching a Broadway show, you notice that, but you don't see all the technical going on behind the show. And, in M&A, and Greg, just to square some of your comments, what are the things that we really know about valuations? First of all, you got to know the growth value. When you're looking at a company, you got to know the trajectory that's built into the price, right? Because you got to earn that trajectory before you get any synergies. So you got to understand the growth value. Number 2, you got to understand what a premium means. When you pay a premium, what exactly are you promising? Especially if you actually go to public markets and say, we're not going to get any synergies for 3 or 4 years. You got to understand what that means. You may be talking about performance improvements way beyond what you've built into your models. And investors will know that, especially if you tell them you don't have a plan. And that's the other thing. If you bring things public, you absolutely have to be able to communicate a plan. You don't have to go through all the details, but if you don't do it credibly, investors will see right through it. And while on average, results from M&A have improved in recent years, there's still a big big variance of returns around announcement in a year or two out. So just to say a few things about what we know.
I think one of the other factors driving valuation here is the alternative to M&A, which is often a buyback, particularly in public companies. And so, there's still a pretty healthy share buyback market. And so that's the alternative use of money in many cases. And I think that is also helping to drive some of the behaviors we've seen in the market.
To tie into that, interest rates, just some quick spot opinions here. I mean, I don't want to brag that I'm in my late 20s to early 40s, but I've experienced two bubbles and busts in my life: the dot-com bubble and the Great Recession. And we've seen some great interest rate fluctuations, through the years. At this point, I think we're at 4.25, and with some ceiling to move up. At what point are you starting to get nervous that the Fed may be getting ahead of itself? And I'll just kind of open that up to the panel if anybody has a strong opinion.
Yeah, I guess I can start that off as well. I guess my view on interest rates is that I don't know that there's a specific number, whether that's in the 10-year, whether that's 3.5%, 4%, 5%. But, I think what recent observation tells us is that there's a lot of concern around interest rates and Fed movements. And so we saw this as we passed 3%, right, and getting close to 3.25. So I think you're going to continue to see the market as we bump up to these additional thresholds in rates, a little bit of a pause in whether you're on the investing side or the selling side, and just kind of look around and say, are we going to be able to absorb this volatility? And we saw in the stock market that we took a couple rough hits for a period of time, and we've since come back quite a bit. And so I think it's going to be a continued, let's see how we do at this level of rates, and we still are at historical lows. So I think as you take all that into perspective, as long as we remain transparent about the trajectory for the next couple of years, and we don't see a lot of changes in Fed policy, for example, I think the market will tend to absorb that. Again, I think we'll see some periods where everybody's pumping the brakes a little bit to see how we're going to get through this patch of higher rates. But I think the market's going to remain resilient, as long as we stay on our existing path, or there's a lot of transparency around where we're headed.
Right. Well, newsflash, right? Nobody in this room or across this country who's in their 20s, 30s, or early 40s has ever managed a business in an interest rate normal environment. Mm-hmm. Right? No Excel spreadsheet exists. No management
depends
exists.
on your definition of normal. Right. I mean, your point earlier was maybe when you think 200 years ago, you had to go to somebody in the town square, and that was your source of capital, and they charge you what they wanted.
Right.
Now you've got, you got the world, and you got all this money, and you got government still printing money like it's like Hakoon Abbott. Is a question about whether or not these, at least in my mind, whether or not even Fed think accommodates this new world with all this money.
Well, I think that's the interesting thing about it. But the fact is, Bob, that the Fed, most of the people sitting on the Fed are closer to your or my age than they are to the guys in their 20s, and they remember, they're using basic economic principles that, and there's a lot of assets on their balance sheet they need to get off. They haven't even started to do that yet, right? So if you think about the amount of assets that have to get offloaded on the Fed balance sheet at some point in time, which is all completely separate from interest rate normalization, right? I think there's probably 10 to 15 more interest rates hikes ahead of us over the next several years. And it's going to take people to a place that most people never have been before in terms of their professional lives. And yes, I admit, I'm the guy that when I got my first mortgage, on my house, in the 70s, it was at 16%. It was like charging on a Visa. It was like, we used to laugh about it. Those of us who are older in the room used to laugh. I could use my Visa and charge my house, right? I mean, that was the higher interest rate environment, right? That was fueled in the Reagan years, and what was a very successful economy, actually. And so all I'm saying is there is going to be this change in terms of interest rates being and interest expense being a meaningful part of the use of cash going forward. Is something that I think people are going to have to contend with.
Just to balance the debate, though, I think even if interest rates do go up a bit, many project decisions are based on, IRRs that are 10, 15, even 20%. So, I think there's still quite a long way to go here before I think it's going to impact project decisions around mergers and acquisitions. And so I personally think it's going to have a much smaller effect than than you might think.
I mean, in our experience, and again, I'll speak to transactions sort of below $1 billion in enterprise value, which again is probably the target of most of this audience. There was a transaction yesterday we were involved in where we put out a formal bid on the buy side representing private equity firms, and it was the first time in a while, we all saw where the interest rates are heading, where we actually revised our bid and advised them to downward. Part of it was the cost of capital. Part of it was actually, and this is the point I wanted to emphasize, the restrictions that lenders will start bringing to the table. So there's the cost of the capital, both the equity and the debt. In a trickier market and when the cost of the debt rises, lenders, whether it be the big banks, whether it be specialty lenders will start adding extra covenants, will start being tougher, as they should be, around how a business is managed on a going forward basis. And then, per my earlier comment, if they perhaps believe a little less about the forecasted growth or synergies on a go forward basis, they'll tighten it. And so it's a little bit of an issue of, it may not today impact enterprise value or deal value, but it's certainly going to have an impact. I know that's one of the topics we're going to come on to, how the newly acquired entity is operated, because I think there's a new set of restrictions that lenders were kind of vacant before that are now going to start to impose, not in a bad way, but it's another restriction that the team that's running the business will have to deal with, in addition to the cost of debt.
Well, thank you for that segue. I want to move on to the topic of PMI, post-merger integration here. And I want to start off in the sequence, Mark, Chris, Jack, and Robert, if you could start off, and then we'll open up to the rest of the panel. But I mean, we've all heard, there's been numerous studies, we've all heard the statistics, 50 to 90% failure rates in M&A or failure to achieve synergies, et cetera. Given that the most alignment is that the majority do fail by somebody's definition, what are some of the key issues kind of structurally, operationally, just from a practical perspective that integration teams have to be focused on when going through this exercise and really kind of absorbing the target?
So I'll give one takeaway comment, which I've been saying for 20 years, which is post-merger is the wrong time to do pre-merger planning. That's a big takeaway. So what does that mean? And I'll tell you, investors see right through this. So most of these comments will be for public companies, but you could equally apply the integration principles to any deal. So when you bring a deal public, you're paying more than anybody else in the world is willing to pay for this set of assets, and that has a stream of improvements built into it. So your integration has to have that line of sight in mind of where those benefits going to come from. And I'll just give you 5 things to remember if you had to start an integration tomorrow. Number 1, you have to have a calendar. All that you're making thousands of non-routine decisions in a very compressed time frame, and people are watching, especially your own employees. So you don't want to show a lack of confidence, and we are going with this, particularly when the people who have to execute it, their livelihoods are on the line. So you have to have a calendar and a phasing of activities. Got to be clear. Number 2, what's in scope and what's out of scope of the integration? If there's going to be particular issues that you won't have enough data to make decisions on, take it out of scope. Put it in if you got 2 brands, you're thinking about rationalizing them, but you don't have enough data, you got to deliberately postpone those decisions. Make it clear about what's in scope, what's out of scope of the integration. And then the third one is I think of them as setting the tone for the integration. How are decisions going to be communicated? Who's going to be involved? Make sure that you're setting expectations for the organization so they know what they're going to do going forward. And the last 2, really important. Number 1, just about every major integration needs an integration management office. And you've got a steering committee, you've got a hub, or the main body, and then you've got the task forces where the work gets done by function. And you got to set that up. It's a living, breathing structure that it better be temporary, because these things could be non-temporary. You can do multi-billion-dollar deals, pre-merger work within 2 or 3 months. You can get a lot done with this living, breathing structure. And then finally, the business plan, which goes right back to where I started. I remember years and years ago, a very famous Harvard professor who sat in a bunch of corporate boards, and he told me, we never really know the numbers up front. We don't really know what the synergies are going to be. And I said, you got to be kidding me. And I was just a doctoral student at Columbia at the time. And I said, What do you think a valuation is? Your valuation is your business plan. Are you kidding me? The valuation has your growth trajectory and the synergies in it. So you got to be very clear that you take that valuation and that becomes your business plan, because if it's not, I mean, investors are going to figure it out someday, or you're, as a buyer, are going to figure it out. So.
Well, just was a side observation. I was thinking about what you just said, that, more and more, at least among big companies, are being required by their major shareholders to report on how they did. Capital deployment is a big deal now in investment, and your own multiple may depend on that. It used to be, said what it was, and there was never a report card. Even in the boardroom, there was a report card. Now it's becoming increasingly part of the equation, certainly an issue when you've got activism and all that other stuff going on. And so I think companies are going to be much more attuned to doing it the way you did, and being disciplined and actually being able to mark the result. Because guys like BlackRock and those guys, they're going to say, how'd you do with that $3 billion or whatever?
That's right.
And I think just to build on both comments, I mean, I think, I do think the board has an accountability post-deal, but also I think a lot of PMI fails because people don't think about M&A as a organizational change. They think about it as a deal, as a transaction, and they don't think about what happens 1 year, 3 years, 5 years after the deal. And I think without that business plan that Mark talked about, and without having that right up front as part of the strategic rationale as to why are we doing this deal, how does this deal align to our corporate strategy, our business strategy? What is the integration hypothesis? Should we integrate or not? Should we keep it as a standalone without integrating? And then, what does that mean as you look to optimize the portfolio later down the line? There was an organization I was talking to quite recently. They did a deal 4 or 5 years ago, backward integration of a company. Great deal. Sold the business recently for 4 or 5 times without really doing much integration at all. And so that was I said to them, were you private equity investors? And they said no. We wanted to leave this asset alone without integrating. And I think sometimes you can integrate something and kill it. And so I think, as you think about how to do that, just think, what is the integration hypothesis, and what do you actually need to achieve your strategic objectives, as opposed to just driving out synergies, which sometimes can be counterproductive.
I think there are 2 PMI fallacies that I think people get trapped in all the time. One is the view that the portfolio manager sitting at a private equity company or the board of directors at the portfolio company can manage integration. They can't. They can get reports on it. They can set an environment for it. They can make it a priority. They can keep track of things. But you need to have the kind of integration effort that Mark talked about. And I think one way you can sort of look at things and figure out whether people are heading things the right way is, in a transaction, post-transaction, is there a chief integration officer, right, whose job it is to work themselves out of a job, and to try and they may come back and be assimilated in some other part of the C-suite, but if somebody actually have that as their principal role. And the other piece that I think that there's a huge misalignment on a lot of times is how management compensation is structured. So often, the management incentives and the incentive plans are not tied to the integration objectives that are set up in the business plan and in the valuation model that was the premise of the original investment thesis in the transaction, right? And in fact, you've got to tie some significant amount of compensation towards that. People act in their own interests, and you've got to have a much closer alignment, not in an unfair way, by the way, not to penalize management, maybe even to overly reward them, right, to reach the objectives that you're actually doing it. Most of us, when we get involved in acquisition of a company, have 2 or 3 key investment theses that are behind why we're doing what we're doing, right? And that plan, those theses have to show up in the integration plan, in the 100-day business plan, in terms of what's going to happen right out of the box, and in the short-term 2 to 3 year management incentive program.
So, Jack, what you're really saying is that executives need to have skin in the game.
Absolutely.
Because one of the things we do know is that executive pay is correlated with the size of the business. So it's almost unless you have some skin in the game on that, you don't lose by not realizing synergies. Now, you may eventually lose your job, but
Look, I'm a huge believer in, and we use it a lot in probably overly viewed compared to market, overly generous profit participation programs, which are designed to do just that, right? If we're getting our pref and we're getting our returns, we ought to make it we ought to really incent people to get that done, to get that work done and help us achieve that.
I've been getting tagged for we're getting close to time here, but I can't let you gentlemen out of here without asking you about the elephant in the room today. I'm running back to vote right after this. Is this going to have an impact? Is a split Congress going to have an impact at all? I'll just go straight down the line, starting with Jeremy. Any headwinds or tailwinds going in 2019 with a split House and a possibly split Senate?
Yeah,
I'm sorry, split Congress. Sorry. Yeah.
The basic answer from my perspective is I think the market is pricing this scenario in right now, so I guess that's the good part. I think if we have any deviation, which clearly we've had in the past, in the recent past, that could create some near-term volatility in the market. But I think as we think about valuation and deal activity, I think most people in this room and in this community are probably expecting a split Congress, so we'll see how things turn out.
Some of the legislative things that will be off the table, like there was a pretty significant movement to regulate the proxy advisory business and that sort of thing. That's gone with a split Congress. And then in a lot of industries, things like renewable credits and stuff like that and refining, those will be really difficult to deal with. So some of the things that people might have put little wagers on, they'll be taken off the table, but I agree, it's not going to change the mainstream.
Yeah, I concur. I actually voted 6:15 this morning before coming here, so I'm good to go. There are guardrails around different scenarios based on split Congress and whatnot, and again, I think for most of the individuals in this room and the businesses you're involved in, you've probably already baked into kind of within those guardrails outcomes. I don't personally see, and our firm doesn't, something that's so on this side or that side of those guardrails that would deviate in terms of how one would run their business going into 2019.
So I'm a Deloitte partner, so I got to be very careful with what I say. But like anything that just think about this as you leave today and as you look at the markets over the next couple of months. Anything that creates more uncertainty or more volatility, like if the market continues to just vibrate in place, that's not good for M&A. That is pretty clear. If the market's going down, there'll still be M&A. There'll just be more cash deals, just something like that. And if it's going up, you'll see more stock. So if we keep anything that causes us to continue to kind of vibrate in place like we are, that uncertainty is going to slow down M&A activity.
I don't think the fundamentals have changed tomorrow versus yesterday. I think the macro environment, the mega trends that are impacting all of the growth opportunities out there, which M&A can help to drive, I think that's the same as it was, and so I think a limited impact.
Look, I think the two things that the federal government could deliver to sort of be an incentive to business was a major corporate tax cut and deregulation, or a de-emphasis on regulatory things and peeling back regulations, putting aside the morality and the politics of it. Less regulation, more freedom for businesses generally is a better thing for corporate America than not. And neither of those two things are going to change based on what happens to the ballot box today. The tax cut's already in place, and is unlikely to get rolled back. And the Trump administration is not, regardless of what happens today at the ballot box, is not going to change its regulatory views on how it's going to approach the agencies over the next several years. So I don't think, frankly, from a macro perspective, that there's going to be any meaningful change.
Well, thank you all. Time's up, as I got the sign. Thank you, gentlemen, today.
Good stuff.